Hello friends, welcome to my channel. In this video you will learn about hedge funds, what are hedge funds, how hedge funds work, types of hedge funds, how hedge funds make money, and some of the richest hedge fund managers. So in hedge funds, money is collected from investors and invested into securities, okay, just like mutual fund. But there is a difference between hedge funds and mutual fund because here investors are not general public. Here investors are high net worth individuals, banks or other institutions can be, but not general public. So this is the first difference, and second difference is the securities here can be land, any kind of real estate, derivatives, futures, options, commodities, while in mutual fund generally invest in stocks or bonds. Okay, so these are few differences between hedge funds and mutual funds. And in case of mutual fund, public money is involved because they raise money from public, right, in small amounts. But in case of hedge funds, they can't raise money from public. There are very few high net worth individuals that are ready to take more risk for more return that can invest in hedge funds. Banks also can invest. There is a list of accredited investors that we will discuss in next slide. Those only can invest in hedge funds, and that's the only reason that mutual funds are more regulated from regulators, but there is not very strict regulations in case of hedge funds. And here is the list of investors that can invest in hedge funds: banks, insurance firm, high net worth individuals, pension and endowment funds. These kind of firms or individuals can invest in hedge funds, okay, and these are known as accredited investors, and they are ready to take high risk for high returns. Now let's discuss the features of hedge funds that makes it unique and different from mutual funds. Okay, so first is hedge fund exclude all the small investors that invest in small amounts. Like in mutual fund you can invest as small as rupees 500, right? But in case of hedge fund, only high net worth individual, banks can invest, and that too amount is always big. And there is one more difference, that in case of mutual fund, if you have purchased those units, you can trade it too, right? And in case you want to sell it, you can sell anytime. But in case of hedge funds, there is no that much liquidity. You cannot redeem it anytime. You have to wait till the period, and after that you can redeem it. And next is hedge fund manager can invest in different assets, not only limited to stocks. But in case of mutual fund, they generally invest in stocks or bonds. But in case of hedge fund, it can invest your money in real estate, commodities, or maybe derivatives, futures, options, right? These kind of assets can also be involved along with stocks. And next is hedge fund often use leverage to amplify their returns. Now what is leverage? You can understand it by a simple example. Suppose you are borrowing $10,000 at 10% interest rate, okay, and you are investing that $10,000 in different class of asset, and you are earning 20% return. So this kind of process is known as leverage, because you are taking risk to amplify your returns, right? Because you have to pay that 10% and you have to earn more than 10% to earn some profit, right? So this is known as leverage to amplify return. Next is, in case of hedge funds, high risk and high return kind of thing, because in case of mutual fund you can invest in large cap funds and that has lower risk, right? But in case of hedge fund, only high risk and high return. Next is types of hedge funds. So there are four common types of hedge funds. First is global macro hedge funds that makes money from market swings caused by economic events or political events. Second is equity hedge funds that makes money by investing in a lucrative stocks or shorting overvalued stocks, right? And next is relative value hedge funds. These kind of fund makes money by exploiting the temporary difference between the prices of related securities, okay, and that's why the name is relative value hedge fund. And the last is quant hedge funds. These kind of funds based on complete algorithm trading that needs knowledge of advanced statistics and all, right? So these kind of hedge funds are there, four common types of hedge funds. Now let's try to understand how hedge fund make money, okay, because hedge fund is not doing any kind of social welfare that they are investing money in securities and giving all the returns to investors. No, they are taking something from them too as a kind of investment or something, just like mutual fund, okay. So investors invest money in hedge fund and hedge fund will invest money into securities, right? Different class of asset. It can be real estate, stock, bonds, debentures, derivatives, any kind of securities. And they will take the fee structure generally is 220. It means 2% on asset under management. What it means? Whatever the asset they are invested, like hedge fund invest in different class of asset, right? So whatever the asset are, 2% on asset under management and 20% on profits. Okay, what are the profits? Suppose hedge fund has invested $1 lakh in a particular security and it grows into 1,20,000. So that 20% profit will apply into that 20,000. Okay, and 2% on asset under management. So this is how the hedge fund will make money, through just like a middleman. Okay, because they are analyzing and they have fund manager, they have employees, they have to pay salaries and all the things, so they are also earning by this. Okay, so suppose 1 billion asset is there, so 2% will apply on that $1 billion and 20% only on profit that can be generated through that $1 billion asset. Okay, and here are the richest hedge fund managers. So Jim Simons, whose firm is Renaissance Technology, Ray Dalio, Bridgewater Associate, Steve Cohen, Point72 Asset Management, Key Griffin's firm Citadel, David Tapper, Appaloosa Management. Okay, so these are the some popular hedge fund managers.